I'm Don Creech, and today we're going to talk about investor reaction and some technical training. So, this is both trying to understand what's happening with investors as they look at the market in the recent week and how they make decisions and how they could make decisions that would be better. The market has been filled with headlines that are fear related, which is why we call this fear or not to fear. We have to decide how we're going to deal with the news. There are plenty of things to create fears. We have the tariffs, we have inflation, we have slowing economic growth both in the United States and around the world. We have uncertainties over the two wars, though they're not resolved, we're in the process. We have Doge, layoffs of federal government, and we see the potential for layoffs in the rest of the economic activity in our country as they lose government contracts or businesses decide to doge themselves, or some states are actually doing that. If you want to look for something to be afraid of, there's plenty of things to be afraid of. And interestingly enough, Nobel research has been achieved in the field of behavioral finance by two economists, Daniel Kahneman and Amos Tversky. A number of years ago, spent extensive time in research on this, received Nobel Prize for it. And Daniel Kahneman died mid-March of last year. Amos Tversky died several years before that. But one of the underpinning assumptions of financial modeling has been that everybody's a rational person. And recently, let me put some charts up here. Recently, this is Daniel Kahneman. He died, as I said, last year. And he's made interesting comments in his research. He was recently, sometime in the last year or so, was interviewed by Jason Zweig, well-known money manager. He writes regularly in the Wall Street Journal. And Dr. Kahneman's assumption that everybody was basically rational, and that's the way investment models are set up. You're probably an investor with modern portfolio theory structure. It's a 60-40 balanced portfolio. And if you're a little more risky, they'll give you 65 and 35, or maybe 70 and 30. But if you don't want to own bonds because bonds are losing money over a multi-year period, you're still going to own bonds because that's the way the model works, because you're supposed to be rational and ignore that for long-term returns. You ignore anything that happens in the short term. But basically it meant that people's beliefs are internally consistent, which means they don't respond emotionally to any external input, which we know is not true. Basically, in a series of simple and brilliant experiments, Kahneman and Tversky refuted that definition of rationality. But Kahneman never contended that people are irrational. Instead, he argued that they are inconsistent, emotional, and easily fooled. Most easily of all by themselves. And years ago, he told Jason Zweig that self-delusion helps sustain most people. In short, he made the case that people are neither rational nor are they irrational, but they are simply human. Well, that's a different twist on things. But let's take a look at what's actually driven a lot of the fear headlines this last week. Is that markets are down. Well, the S&P is down by 10%. Oh, it was on Thursday. Actually, on Friday, it rallied a bit, so it's not quite down 10%, though it's clearly still in a downtrend. Now, what was missed earlier in the week and didn't generate as much in the way of headlines is that the NASDAQ, where the Mag 7 stocks are housed, is down 20%. That happened a week ago on Monday, and it's in the news on Tuesday. This was Bloomberg's report. And by virtually any accounting, the winners, and just think of the Mag 7, you have Microsoft and Amazon and Apple and Netflix and Facebook, and you've got Google. And then there's the Mag 7 plus T, which is Tesla, which you can argue is not really a technology stock because it's involved in so many other things. I mean, that's an analyst perspective. But you had NVIDIA, Microsoft, and Apple have soared to valuations of $3 trillion. Amazon and Alphabet weren't far behind. Tesla was up at $1 trillion for weeks. Wall Street's been cautiously moving from tech to more defensive sectors. It's kind of an on-again, off-again trade policy. And that's unnerved investors and has created the headlines for, is the market falling apart? Is the economy going into recession? There's lots of reasons for your stomach to be churning and not sleep, and you're not sleeping at night. And then inflation's a little stickier than people thought. The transitional inflation didn't transition back to next to zero that we had a decade ago. That rotation accelerated as we got to the end of the week, and that really did unnerve investors who have been concentrated on growth. And then following up on this, Schwab, who has, I don't know how many investors they have, how many accounts they have, but it's massive. They're one of the largest broker dealers in the country, probably in the world. And one of their chief analysts, senior investment strategist, Kevin Gordon, shared a similar chart showing that the NASDAQ was down 20% from its high. Well, that's real bear market territory. If you're down 20%, that should unnerve people. And the reason why is the time to get recovered is possibly very substantial. If you're down 10% in the market, you need 11% just to break even. If you're down 20, you need 25. And we know from history that markets don't generate 25% a year very often. We just had two really strong years right behind us here. The odds of that repeating this year, statistically, that's really, really slim. And then you think back to if you were an investor back 2 decades ago and you were in the tech bubble and you were in tech stocks, you're down 90%. I mean, whether or not you got even was a matter of good strategy on the way up and hanging in there instead of staying in cash out of fear. But let's take a look at the way markets actually respond, because markets respond to people. People have emotions, so their emotions drive what they do with stocks, and stock prices are trackable. We happen to use charts that are called candlestick charts. Now, if you're a really short-term trader, we call them swing traders, they're looking for anything that may last from a couple of days to a couple of weeks. They're really paying attention to the 5-day moving average, which on this chart is the red dotted line. And for them, they would have been selling and raising cash up here somewhere around 6,100. And even now, 1 day above that average is not going to make them buyers. They're probably still sitting on the sidelines with the bulk of their portfolio. Now, if you're a little longer term investor, you may be willing to hold things for maybe 4 weeks to a quarter. You're looking for the 21-day moving average. Still would have gotten you out about the same place that the short-term traders did, and you're not thinking about getting back in. You want to see this downtrend reverse. Now, position traders, they typically are looking at holding things for a year or two. They have targets that they're going to need the money, and so they're paying attention to the 50 moving average. And I just realized I drew the wrong line here. This is the 50 moving average. They're much more patient. They're going to wait for the money to get back above there, the market to get back above there. Now, if you're a Warren Buffett follower, you're looking at the 200-day moving average, which means you are officially in a bear market as far as financial media is concerned, in the SPX, in this S&P 500. Now, that should be concerning. Am I going to lose money? Is this thing going to turn into not a 10% drawdown, but is it going to turn into a 30 or 35 or 40% drawdown, because we know it's a substantial amount of time and very great difficulty to get back to that level? Well, this market is not a normal market because we have President Trump, and he's a disruptor. We learned that as President 45, We now see him actually implementing things he talked about doing and had no cooperation in his first term. And now he's prepared to do that, and he has a team of professional money managers, because most of them manage corporations, and they have made a decision that the country's health and welfare is more important than them making another $100 billion, for instance, by staying in their firms. They are volunteering to come in and work as government employees, as advisors to the president. And that's a whole new situation. We haven't seen anything. The closest we ever got to that was President Reagan. And he had some cooperation from a Democrat Congress, but he was still fighting the bureaucracy. So that's where Doge and the fears come in related to that. But when we take a look at this, market has components. We have the fear that investors have. We have what's going on in business, and business earnings are actually still good. And CEOs are not even talking about a recession. They're talking about more growth. Well, if they're going to grow their companies, they see that coming downstream. They've got a way to adjust the tariffs. Well, that's a positive. That should offset some of the fear we have. But we also have some technical reasons. We happen to subscribe to Vantage Point AI software. And when we look at the S&P 500 chart here, one of the things that you'll be told about investing and staying invested, just don't go to cash, because you'll never know when to get back in. And besides which, a seasonality basis, this market is still strong. And that's basically what this upper line shows. This is seasonality over 20 years. Well, this isn't a 20-year typical year. This is a radically different year than any of the 20 years that we've just been through. So we have to ask the question, what good is this seasonality data when we can look at seasonality data that is adjusted for this year? We take the past years and we see how they operate given a more similar circumstance. This particular red line is developed by Larry Williams. And if you happen to be a subscriber to stockcharts.com, you can subscribe to Larry Williams' data. We get this through Vantage Point software. I also have access to it through Stock Charts because I subscribe there also. But this basically says that this 10% drawdown that we're just gone through is very close to a bottom. This dark green line basically refers back to a prior low in the market. And that's typically where you see buy the dippers come in, opportunistic investors come in. They may have short-term tolerance for drawdown right now, but they're very likely to start tipping their toes back in here. And that's basically what generated the upside on Friday. However, a lot of that was short covering. It wasn't a new inflow of massive amount of money. Friday's buying in both the Dow, the S&P 500, and the NASDAQ 100 were on below average volume. There was some buying. There's a little bit of bargain hunting, but most of the buying that occurred this past Friday was people who have been short the market, decided, hey, this is a really decent gain. I'm going to take my money. And in order to cover their short, they had to buy back their position so they could return the shares to their broker. If you're not familiar with that, you look up short selling on your local browser, or you can give us a call this week. We'll be glad to talk to you about it. We only have one portfolio where we consider short selling, but it is generally a pretty high risk activity and is rarely entered into by us, certainly not for client accounts. But all of this concern about fear and the market's going to fall apart, that we're going into a recession, we need to take into consideration that while this last 3 weeks of 10% drawdown is the 7th fastest drawdown since 1929, that's enough to shake us up. But let's talk about perspective. Perspective here is that the S&P 500 over the last week was down 2.25%. Over the last month, that's down 5.25%. This is noise as far as the market's concerned. Over the quarter, it's down 4%. Year to date, it's down 4%. Over the 1 year return, well, we've given up half of last year's return, down 10%. If we look at the last 2 and the last 3 years, it's up 47 over a 2-year period. It's only up 41 over a 3-year period. Those are not bad numbers. The fear that you get on the headlines is intended to scare you into buying something that they are selling. That's how newsletters get sold. Is fear-driven headlines cause people to subscribe to newsletters. After 2 or 3 years of nothing as disastrous has happened, people quit subscribing and they have to put out a new fear-driven headline to get new subscribers. So how are you typically supposed to do this, deal with this kind of market? If you are listening to financial media, you're following a lot of different gurus on social media, you are basically told that your answer is in asset allocation. You're supposed to own a whole bunch of stuff. You own bonds because you don't know how they're going to work. You own stocks because you don't know how they're going to work. Own real estate because you don't know how they're going to work. Own international because you don't know how they're going to work. So just put a whole bunch of stuff in the stew pot and eat the stew. Is that really what we want to do? What about taking a look at what's actually going on in the market, which we do on a regular basis? We do this every day. What's really important to us on a scheduled basis that we look at because we have a plan. We follow the plan, we follow the rules. And when we take a look at the 11 sectors that are components of the S&P 500, we look at the spider sectors. We add FTSM, which is First Trust Enhanced Short Maturity Exchange Traded Fund. It invests in corporate credit notes less than 60 days in duration. The ticker's ETF, the ticker's FTSM. We rank these on a monthly return. How are they doing over the past month? That's what this last column is. The only thing that's outperforming cash is energy. And even energy this last week has some risks that are rising that we should be aware of. The red and green buttons, consider those traffic lights. If you're driving your car, you know what green traffic lights are. You're okay, you can go ahead. If they're red, not so much. You got to be on alert. In fact, you don't want to be running those red traffic lights. Well, these act as a similar signal in our portfolio decisions. This comes from tc2000.com. It's inexpensive software. You can buy it yourself. Doesn't take real long to learn it, but in order to get good at decisions, it's typically 4 to 5 years. But you need some rules. Once you set up the rules, you pay attention to the data, and then you act on it. That's not such a bad deal. You can figure out what to do, and you should be, or what are you doing? You're just sitting back in your easy chair, assuming everything is going to be okay? Well, that's one way to handle the market, but that probably isn't going to ease your calm. I showed you this because there are ways to take a look at the market data. You should ignore headlines. You need to look at the data, what's actually going on in the market, because it is often disconnected from the headlines and from the economy. The market forecasts what's going on. But what we've seen in the last 10 weeks, while it's more rapid than many drawdowns, is not significantly different than anything that's happened probably in your investing lifetime. Go back a couple of decades and you've been through some stuff that's worse. This does not appear to have the making of being one of those. We do look at data that suggests we're very close to seeing this bottom out. We're waiting for some confirmation on that, but we rotate into other asset classes. What most people are totally unaware of is that what's going on here in the United States has actually made European investors and some Asian markets much stronger on a relative performance basis. So rotating away from the US market, putting account emphasis, portfolio emphasis in foreign markets has actually sustained returns and avoided the strong drawdown that we've seen this last week. But if you're just simply saying, I have asset allocation, I own a little bit of that, well, a little bit of that and hanging on to a bunch of stuff that's losing isn't good strategy. If you want to talk to us about it, our contact information is coming up. Stay tuned to us. We'll have another one posted later this week. Have a great day and a great week and successful investing.